Okay, in this video we want to talk about more trade information. Our next chapter. We'll first have a little quiz, see if you can do this, illustrate and explain the three chapters of tariffs. Note that the three chapters include with no trade, just all local supply and all local customers. And then the second chapter or scenario would be allowing foreign trade. And then the third chapter or scenario would be what happens when you impose a tariff. Please also note the changes that you would observe in the surpluses, both consumer and producer surpluses, the changes in the total market supply and how the market is shared between the domestic and the foreign producers, and then also indicate what the total revenue, the total tariff revenue would be, and then the two deadweight loss areas. So just take yourself a minute and try to do that. When you're done, just pause and then go forward. All right, so your graph should maybe look something like this. With price and quantity, show a demand curve and a supply curve, a local supply and demand curve, where your equilibrium would be. The consumer surplus is the area above the price line and below the demand curve. You could measure that area. If you do have a scale on the grid, you could quantify that and measure it. The area below the price line and above the supply curve would be the producer surplus. You could measure that as well, total them up, and get the total surplus that's being generated in that market. So look at the second chapter, which would recognize that you have foreign competition or foreign suppliers. Let's assume they come into the market at a $6 rate, and they can supply as many units as the market demands at that $6 rate. So the supply curve would be a flat supply curve at $6. Let's call them dominoes. The new supply curve would be a combination of the two supply curves, and it would be a kink. So it looks something like this. From that, you could determine the total market would be 7 units. The supply provided by the local market would be the area before the kink, or the Pizza Hut supply curve, up to 3 units. And that would be local. After the third unit, the rest of the market would be supplied by the foreign supplier. Note the reason that the local market can only provide 3 units is to go beyond 3 units, their costs would be greater than $6. Therefore, it wouldn't make any sense for them to try to produce more than 3 units at that price. So also noting the increase in consumer surplus, the size of that, and the reduction in the local producer surplus area. That would be significantly reduced. Your total surplus is still greater with foreign trade or foreign supply. You'd be up to $58 in this case, so you'd have an increase from 50 to 58. But we also recognize that consumer surplus increased significantly. Producer surplus actually was reduced. The overall surplus is greater. So the third scenario would be what if we impose a tariff? And in this case, a tariff would be a $2 tariff. If we plug that in, what would happen? Now the supply curve for the foreign supplier would actually be at $6 plus the $2 tariff. It would be an $8 curve. We would redraw the combined curve, putting the Pizza Hut curve together and the Domino's curve together. We'd get the new overall supply curve, and our supply would now, our equilibrium would be at 6 units. And that would be divided up between 4 from the local provider and 2 from the foreign provider. We note a couple of things here. That consumer surplus is dropped. That area that was consumer surplus before is going to the local producer, as well as to tariffs and deadweight losses. There's our producer surplus. There would be the size of both of those surpluses and the total. Note that we still have a surplus that's greater, even with the tariff, than without any foreign providers. So that would probably be what your chart looks like. We would then go in and describe the area of the tariff. The tariff, once again, is a $2 tariff on the 2 units that the foreign provider is producing. It would be this area right here. In addition to that, we calculate the size. $2 times 2 would be 4. We also note that we have 2 other little areas. Those are deadweight losses. The area on the right is a deadweight loss due to a customer leaving the market because the price had gone up. The reason that's a deadweight loss is Domino's was willing to sell at 6 and the customer was willing to buy at 6, but with the tariff, the customer leaves the market, therefore that value is destroyed or is never actually manifest in the future. The tariff on the other side, on the left side, or the deadweight loss on the left side of the tariff box is due to the loss that you have because now Pizza Hut is making the pizza, and note that their costs are above Domino's, so you have this inefficiency deadweight loss. So both of those actually, we can calculate those, and you lose $2 in deadweight loss. Those actually leave the market. So your story should look something like that. Okay, ready to go on to the next topic. Actually, if we could summarize the tariff scenarios, the first one would be the local only, what we would have on the price, quantity, and revenue, as well as the 2 surpluses that provide the total surplus and the tariff and deadweight loss. Remember, we don't have any tariff or deadweight loss if it's just the local market, so those are both 0. If we do allow outside suppliers to come in, or with world supply, the price and the quantity both change. Note that revenue declines, consumer surplus increases, the local producer surplus declines, but total surplus is actually larger with foreign supply. No tariff has been imposed yet, therefore there's no deadweight loss. Once we impose a tariff, we do allow trade, foreign supply, but we're going to impose a tariff. The price is going to go up. Quantity goes down because that demand curve is downward sloping. Consumer surplus declines. Local producer surplus increases, so the total surplus is still above what it would have been with just a local market only. Tariff revenue of 2 and our deadweight loss of 4. So that's a nice summary of the 3 scenarios or chapters that you've drawn up. Okay, we're ready to move on. All right, we're ready to move on to the next topic. We want to review the 4 cases for trade. We can make a theoretical case, a moral case, an economic case, and an empirical case. The theoretical case is based on this idea of trade and specialization will advance and create value, and the individual responsible for making that case was Adam Smith. The other theoretical case would be the idea of comparative advantage increasing value or wealth, and that case was made by David Ricardo. So our theoretical case sets on those 2 individuals and their ideas. The moral case makes the argument that human beings have natural rights to be able to associate with each other and create value relationships, whether or not these end up being economically beneficial or not over compelled relationships is secondary. The case here, the argument is that human beings have this natural right to trade with one another, therefore it is morally justified. The next case would be a political case, and the political case makes the argument that when individuals cooperate with each other, that it promotes peace. So if we want to increase peace and reduce tension, we would be in favor of allowing trade to occur. And the economist that really made this case was Frederick Bastiat and his arguments about the political value of free trade. And then the last argument would be the argument based on the empirical case, where we look at the evidence and experience that we would use to support the case. In other words, we look at the value that's being created and just simply measure that and conclude that we have the basis based on the empirical evidence of the value that's being created to justify trade. So we have those three cases: the theoretical case, the moral case, the political case, and the empirical case. All right, I want to talk about something a little bit different here. So China and the U.S. The U.S. has imposed some tariffs against China, and China has reciprocated. Are the tariffs against China to protect U.S. industries? Well, they kind of are against Chinese industries, but they're not protecting U.S. industries because we allow supply from other countries to come in. In other words, Vietnam and Thailand and Philippines could all pick up and produce these products that China is currently producing and sell into the U.S. markets. So it's more directed at China and Chinese companies, not primarily. The beneficiaries right now are U.S. firms, but we're not limiting competition from these other potential suppliers. So supply chains move to other countries if they face tariffs. So the question really has to do with are the U.S. and China rivals in terms of maybe military or empire rivals? And if that's the case, then tariffs can be justified based on preventing this rivalry or not granting your rival the benefits of trade. And that may be one of the cases that you could make opposing free trade, that you are actually trading with someone that's your rival that could compete with you militarily in the future, and you would want to avoid that or prevent that from happening. So the other issue would be, should you have free trade with unfree countries? We note that China is a totalitarian dictatorship, that people have much less freedom politically and otherwise to exercise in China. Therefore, is the case against China that we're really trying to punish the Chinese government to allow more freedom with its citizens, and we do that through trade limitations. That could be another argument that could be made. All right, so we want to start talking about another item, exchange rates. How are exchange rates determined? We first need to think about what is money. Money fundamentally is trust. Money is based on individuals willing to trust that currency. People accept money because they trust that someone else will accept the money for the things that they want to buy or exchange. So, under a globalization scenario, when we think about globalization in 1950 versus today, the volume of globalization in 1950 or international trade was very low. Today it's very high. In 1950, there was another difference. Exchange rates between countries were generally fixed. In other words, the rate that I could exchange dollars for British pounds or Japanese yen, it was a fixed exchange rate. Today, that's different. The rates are floating, or the market determines that. There's no guarantee about that exchange rate. So a floating exchange rate, the rates can change with every trade. Every time two parties want to trade currencies, that negotiated rate could change. How large is that foreign exchange market? Well, or we call it the Forex market or the foreign exchange market or the FX market. The volume there is about $5 trillion daily. How much is that? It really dwarfs all other markets. That daily volume of 5.1 trillion, the U.S. Treasury, for example, is running about 530 billion worth of treasuries that get traded each day. So the FX market is over 9 times larger than the U.S. Treasury market. If we look at the New York Stock Exchange, how much volume of stock is traded every day? It's about 40 billion. So the FX market is over 127 times larger than the stock exchange on a daily basis. So it's a huge market. There are over 100 different currencies that get traded in this market. The major trading centers are located in London, New York, and Tokyo. If you go to a foreign exchange site on the internet, you'll find some kind of something that looks similar to this, a cross tabulation, which would allow you to pick a currency over there, one unit of that currency, and tabulate it against how many units you would be able to get of the other currency. So, for example, if I had New Zealand dollars, the NZD had one of those, and I was going to go buy US dollars, one New Zealand dollar would be worth 0.7285, about 72 cents. You would get about 72 cents of the US currency. If I were to have the US dollar, note if I go up to the US dollar row and then I go across to the New Zealand currency, I would get about $1.37. Note that $1.37 and 0.72 are reciprocals of each other, depending on the direction of the trade. So we have this foreign exchange market today. It's characterized as a free market where rates are floating. Buyers and sellers determine those rates, and those rates can change possibly with every transaction that occurs. Okay, so the way to think about this is the US dollar price would be equal to the foreign price divided by the exchange rate. So if I know the foreign price and I know the exchange rate, I can convert it back into the US dollar rate. So if euros, I needed to buy something and it was 1,000 euros, I could just pull up my chart and see what the current exchange rate is, a euro to dollar or dollar to euro. I note there that 1 euro will buy $0.8146. So if I take the euro price, divide by the exchange rate, that would tell me how many dollars I would need to buy that item. So I take $1,276, I go buy euros. The exchange rate is $0.8146 to actually the exchange rate is $1.22 will buy me 1 euro. So what I would do is take my $12.76 in dollars and go exchange at that rate, and I would come out with 1,000 euros. All right. Okay, so if I had $1,000 and I was trying to convert back to euros, I would just divide it back against that exchange rate going the other direction, and it would tell me that $1,000 is equal to about 815 euros. All right. Okay, so the foreign currency exchange rate, we always remember that it's done in pairs. So you'll have two currencies that get swapped. So there's always a pair there. So let's do a little exercise here. The U.S. and Saudi Arabia both have their own currencies, U.S. dollars versus Saudi Arabian riyals or SARs. And the current exchange rate, this is one interesting currency because it is actually fixed. The Saudi Arabian government does fix their rial to the dollar at a rate of 3.7 rials to a dollar. So one rial is worth about 26.7 cents or $0.267. So when I'm in the U.S. and I want to buy a Big Mac, I just take my dollars down to buy the Big Mac. If I want to do that in Saudi Arabia, I would first have to convert my dollars to rials, and then I would make the purchase. So here's a question for you. Where would you prefer to buy a Big Mac, Saudi Arabia or the U.S.? Let's say in the U.S. it's $3.50, and Saudi Arabia it's 15 rials. How would you calculate the Big Mac exchange rate? Well, you take $3.50 and multiply it times that exchange rate, which would give you an indication of $13.13 rials is what you're effectively spending in the U.S. In Saudi Arabia, you could take their rial rate, divide it by the exchange rate to dollars, and it would come back at $4. So in the U.S., you're paying $3.50. In Saudi Arabia, you're effectively paying $4, or if you're in Saudi Arabia paying $15, in the U.S. you'd be paying $13.13. Now, an arbitraging entrepreneur, what would they do in this case? Based on the law of one price, they would try to buy low and sell high. In this case, they would try to buy in the U.S. and sell in Saudi Arabia. If they can do that, they can earn 50 cents. In that case, we're going to ignore transportation and other transaction costs. But we note here that over time, what would you expect to happen to those two rates? Well, as demand increased for Big Macs in the U.S., that would push the price up. As supply increased in Saudi Arabia, it would push the price down. And both those prices would end up being somewhere theoretically around, $3.75 or so for that rate. All right, so the demand for dollars is really based on foreigners who want to buy U.S. dollars. And why would they buy? Well, the first reason is they'd want to buy some goods or services, or they might want to buy some securities in the sense of stocks or bonds in the U.S. Another reason that somebody would want to buy U.S. dollars is they would want to speculate in dollars. Buy the dollars today cheap and try to sell them in the future where the exchange rate is moved that would yield a greater return of the trading currency. The supply of dollars, Americans wanting to buy foreign goods. In other words, I've got to trade my dollars for other currency in order to buy that other currency. Same kind of thing. I want to buy their goods, services, or I want to buy securities, or I might want to speculate in their currency. All right. So let's think about this graphically. There's the dollars, and let's say it's the yuan per dollar. And there's the demand curve, and there's the supply curve. It would give us equilibrium. Let's say that today it's at 630, the exchange rate. What happens if Chinese want to buy more American goods or services? That would increase the demand for dollars, pushing that demand curve out and to the right. The new equilibrium is going to go where? It would be pushed up here, so it's going to cost more yuans to be able to buy a dollar than it did previous to this shift in the demand. Now what would happen? Your new equilibrium would be up here. You'd have more dollars in the market, but they'd be at a higher price because that demand is shifted to the right. Now what would happen if Americans wanted to buy more Chinese goods and services? In that case, the supply of dollars would increase. Americans would want to trade their dollars for yuans to be able to purchase those goods. So the supply curve would move to the right. The new equilibrium would be pushed out to the right. It could end up being out here. All right, so you might want to rewind this a little bit and review that theory and how that works. Changes in supply and demand will change that dollar to yuan rate. Okay? All right, so we could look at this the year to date. Here's one for 2018, where we start about 650, and the rate would move up and down. Note that over that period, that actually that was a year to date that went up to just the first 3 months in 2018. The rate had fallen by 3.15. So what would you say is happening in terms of the supply and demand for between dollars and yuans? Just let you think about that. Okay, here is what happens in 1 week. You notice that these prices are moving up and down. If this is over a week, this is actually over a day. So you can see here, if you were in the FX speculation market, that you could be trading currencies back and forth throughout the trading day. And if you could figure out how to buy at this point and sell at that point, and do that over and over again, you could make a tremendous amount of profit. In addition, if you had that situation with the other direction, you could have a significant loss. So the foreign exchange speculation market is huge. This trading of currencies back and forth can be really significant. Okay, once again, think about that chart and what would cause that exchange rate to go up or down. To go down, it's either going to take a shift in supply to the right or a shift in demand to the left. For the exchange rate to go up, you have to have a shift in demand to the right or a shift in supply to the left. Okay. All right, so let's talk about the supply of dollars. Supply of dollars is really going to be a function of income, relative prices, and interest rates. Why would someone want to sell dollars? They're interested in finding another currency, for example, that's yielding a higher interest rate. So people are striving to try to maximize their return or their income relative to the risk that's associated with these different currencies. Demand for dollar, kind of the same thing. The income, the relative prices, and the interest rates. All right. Okay, let's talk a minute about purchasing power parity. Purchasing power parity looks at exchange rates. They're always adjusting for this relative purchasing power when currencies are equalized. The idea here is what can I buy in Saudi Arabia versus what can I buy in the U.S. after I've adjusted for exchange rates. If a Big Mac is really $4 in the U.S. and $3 in or $3.50 in the U.S., it would take less money to have the same level of lifestyle in the U.S. relative to Saudi Arabia. So we can't just measure the prices against each other. We really need to make this adjustment for purchasing power parity. And in order to do that, we would want to compare wages and other factors to see what really is the cost to buy those products in different countries based on income, which really is a function of the time. So we kind of go back to this idea of the time cost of things between countries, and that shows up implicitly in the price and the purchasing power parity. Okay. All right, so we want to talk a little bit about the balance of trade and trade deficits. The balance of trade and trade deficits very hot topic right now because countries run surpluses or deficits. So the question we have is this good or bad? Well, to understand this, think about the U.S. and China. The U.S. is trading TVs for dollars. So they're going to charge $300 for $300. What happens after the trade? Well, the U.S. Customers get TVs and Chinese companies get dollars. It seems like a pretty interesting trade. If someone's willing to trade you things for just currency, it seems like the winners in this deal would be the people who receive the goods and services, and those who just receive currency. They might appear at first glance to be losers in this trade. Well, we have to think a little deeper about this because before we do that, let's think more. Let's make sure we understand what a trade deficit is. A trade deficit is when you're importing more than you're exporting, and a trade surplus occurs when you're exporting more than you're importing. Now, the way that economists analyze this is with two different accounts. One's called the current account. The other one's called the capital account, or I like to call it the financial capital account. And the current account consists of the current merchandise account, which is goods and services. We note that goods historically have been the primary thing that's been traded, but we also observe that more and more we're seeing services traded. So we want to account for both goods and services. We also make a note of transfers that occur. These transfers are in the form of just direct transfers between countries. These, in some cases, will show up as foreign aid between a country. They're just simply a transfer. There's no goods or services exchange. It's just a transfer straight up of income. All right, so the merchandise account, once again, includes goods, and I think of goods as stuff that you can touch. And it's got kind of a limited scope when we think about that. Just the goods, the things that we can touch. The goods and services account is the merchandise plus services. So merchandise are goods that you can touch. Services are things that you're providing between people. There's no inventory with the service. Okay, so other transactions in their current account would be interest and dividend payments and remittances and foreign aid. Remittances are simply transfers of income from individuals in one country to an individual in another country. All right, so the current account would include those. The current account does not include investment flows. Investment flows show up in the capital account or the financial capital account, and that's where investments are tracked. So the capital account would track investment flows, foreign direct investment, portfolio investment. Remember the distinction between foreign direct investment is when someone invests directly in another country to create a company. Foreign portfolio investment is when you're investing in a company that's already located in that foreign country. Also included in this capital account is debt, real estate, and cash holdings. Okay, so debt would include bonds that you would be buying. You would be purchasing debt. Okay, so the current account plus the capital account, those two, when you add them together, always equal zero. So, U.S. and China trade TVs for dollars. The accounting would look something like this. The current account for China would show an export of minus 300, and it would show a capital account of plus 300. In other words, you take out of your inventory 300 in the form of a TV, but your cash account now shows an increase of 300. The cash receipt for the TV. So your net account would be zero, or your trade balance would be zero. On the U.S. side, the current account would show a $300 increase with the import of the good, but your capital account would show a $300 negative because you're using that cash to buy the TV. So your net, once again, is zero. All right, does that make sense? So what does China do with the $300? Well, if China wanted to buy Apple stock, they would take the 300 and buy the number of shares that they want with that Apple stock. They would be trading. What happens to their accounting system? Well, that would have no effect on their current account because they're not trading a good or service. They're simply trading stocks or an investment. So the capital account cash would go down by 300, but the capital account investment would increase by 300. On the U.S. side, there would be no change in the current account because you're trading stock in Apple. You're not trading Apple products. So the capital account would have an increase of cash of 300, but your capital account for cash would show an increase of 300, but your capital account for investment would decline by 300. So think of these individuals trading between each other and what happens to their own accounting, and then expand that out and think about the whole country, what's happening there. So the balance of payments is a record of transactions between a country and the rest of the world over a period of time, usually 1 year. So credits occur when foreigners make payments to buy your stuff. Debits occur when you make a payment to buy foreign products, goods, and services. So under merchandise exports, those are goods. Once again, a merchandise export is goods that are sold to foreigners. Merchandise imports would be goods bought from foreigners. Your balance of payment would be your current account plus the capital account, and we always remember that's going to equal zero. So let's think about a balance of payment reconciliation. So we begin with the first item, which would be the current account. The merchandise exports in a current account. Your receipts or your credit would be 400. That shows that you've sold 400 worth of exports. You would also have imports. If you had imported $600, you would have made that payment or had that debit against your account. So the balance would be negative $200. You'd have a negative trade balance of 200. Now, once we've done the merchandise, and this is where most of the focus occurs when we're talking about trade, is in this current merchandise account. When we say we've got a negative trade balance with another country, it's primarily this accounting that occurs in the current account with the merchandise. But we note that we also need to add services. So in this case, if we were to show net export services, where we're showing the receipts and the payments, netting that out, if we were to add 50 to that, it would actually show that we have net exports there. In this case, this country is exporting more services than they're importing, so they show a positive net export balance. Note that the trade balance, when we adjust for the net exports of services, it actually goes down by 50. All right. And then the last category are these unilateral, net unilateral transfers, where we look at transfers between countries. It could be transfers that have to do with foreign aid or remittances. And let's say that there was a value of $30 there that was remitted to another country. So your current account balance is 180. So that is the status of the current account balance. How does that reconcile against the capital account? Well, the capital account, if we had 280 of inflows, our balance would be 280, and we had 100 in outflows, our capital account balance would actually be that same number. So we've got minus 180 against 180. And the way we confirm that is we add up these columns. All the receipts have to equal all of the payments from both of those accounts. So the overall balance of payments is going to end up being 0. Once again, when we talk about a trade balance, where is that discussion occurring? It's generally occurring up in the current account under merchandise, exports, and imports. But we always recognize that your overall balance of payments has got to be 0. The other country that's buying your products is holding, the other country that is selling products to you receives cash in exchange. That cash also shows up in the form of investments, or they simply are holding that cash. In that event, their capital account is going to change at the same rate that your country's capital account is going to change. Okay, so hopefully that makes sense. So the balance of payments and the exchange rate are tied to each other because receipts are foreign demand for dollars and payments are local supply of dollars. Okay, that's our lecture for today. I look forward to giving you the next lecture. Want to once again review what we've done here. We've quiz on how to illustrate and describe what happens with tariffs, the 4 different ways that we can make the case for free trade: theoretical, moral, the moral case, the economic case, and the empirical case. And then we talked about the foreign exchange market, the size of that market, as well as how those rates move up and down. And then we discussed the balance of payment accounting, how that works. Okay, very good. Thanks for watching this video.